Okay, this is the chapter 13, which is now we're going to start doing some control based on the budget that we did last time. So we did the budget. Now it's time for us to do some control. What is control? What's the purpose of control? Purpose of control is only one: to make sure that you follow the plan. Again, get a big picture. You have a goal. You have alternatives, you already evaluate the alternatives, how you can reach your goal. You choose the best alternative for you. You prepare your budget, means that you make the detailed plan of how you're gonna use the resources, from where the resources gonna come, and how you're gonna use the resources in order to reach your goal. Now it's time to start doing some control. Why do we need that control for? To make sure that you follow the path and you follow the plan that you set up for yourself so you can reach your goal. If we eliminate the control from the entire process, that means you might never reach your goal. Now the question is, do you want to reach your goal? Obviously, everybody's going to say, yes, I want to reach your goal. So for that reason, we need the control. So then don't look at the control something bad that you have to do every time when I mean, I don't know for you, but at least for myself, every time when I see control, it's like, oh my God, red flag. I have to worry about. No, you don't have to worry about the control. The control is actually a good thing for you because it tells you where you are to compare where you want it to be. Are you ahead or you're behind? And if you're behind, make adjustments, get to the pace that you want to be or the place you want to be. And if you're ahead, then keep going. You may reach your goal faster than you're expecting. So those are the learning objectives for today. And let's start control. What's the budgetary control? This is the key management function again. And this is the components of this function. First, we have to get the actual results, where we are currently, and then we have to compare where we currently are to where we want it to be. What was our plan in the first place? Then we have to provide the feedback, obviously in this case for the managers, but since you're the managers, you're going to give your feedback to yourself. So you're going to say to yourself, hey, I'm doing good. No, I'm not doing good. Or I'm on the plan to get my whatever I want to get, or maybe I'm not in the pace to get what I wanted to get. So then you have to make adjustments. And once we provide that feedback, then we have to prepare some report. And the question is how often we have to prepare those reports. Ideally, I'll tell you to prepare those reports every day. In reality, that's not going to be possible. So do it at least monthly. And so based on the report's results, once we see the results from the report, what we have to do? We have to see, is there any differences between where we are compared to where we want it to be? Then if there's a differences, we have to analyze those differences. Then we have to determine what's the cause for that difference. Then we have to decide or plan for any action that we need to do in order to correct ourselves or organization so we can get back on track. And the last thing is to see, is there any reasons to adjust our plan? Because maybe we're never going to achieve our goal. So the small picture is develop budget, prepare the plan, compare the actual with the budget. But in order to compare the actual, you have to start to work on that. Because if you don't start working, if there's no actual activity, there will be nothing happen. So there has to be some action, some activity, something has to happen in order to have some actual results. Once you have the actual results, you can compare it to the budget. Then we're going to analyze the differences between the actual and the budget. Then comes to the point, do I want to do, am I on the right track? If I'm not on the right track, or I'm not on the right track, what do I have to do to get back on the right track? And the last thing is, do I need to modify my plan? Is that plan still realistic? Is it still achievable? Or I have to change it and move to the new plan or new budget or new ideas? So work must be done when the company have the form on the report. So in that case, we have to identify the name of the budget report, such as sales budget or manufacturing overhead budget, which exactly was the budget that we're chasing here. Then we have to stay how frequently we want that report. Do we want it weekly? Do we want it monthly? Do we want it quarterly? How exactly we want it? Then we have to specify the purpose of the report, identify the who is responsible, who's going to get that report. So basically, we have to do something like this. First, name which report, how frequently we're going to prepare that report, what's the purpose of that report, and who's going to get it. That's actually a very good thing. I'll suggest you to get something like this, copy it for yourself, and keep it somewhere. So when you start being a manager and when you start working as a manager, that's going to give you some ideas. What do you need and how often do you need it? And in that case, that's how you're going to keep yourself organized. You don't have to have in mind always the company. You can easily adjust this for your own purposes. So basically what you can do, how often do you need to check your bank account? When you check your bank account, what exactly you're looking there? And who's going to get it, that report? And then the next will be, how often do you want to check your expenses? How often you want to keep track of your expenses? Do you want to keep it daily, or you want to keep it monthly, or you want to keep it weekly? What exactly you want to do? What kind of report you want to prepare for yourself? What's the purpose for that report? Is it to show you the total expense, or is it to give you the detailed information about the expenses? And or it's going to tell you how exactly you're spending, how much you're spending, and on what you're spending. So you can have different ideas here, and you can easily adjust it for the name of the report, what would be exactly, how frequently you want to do this, and what's the purpose for that. The starting budget, obviously the starting budget is the one who is prepared for only one level of activity. So the master budget will be our static budget. Why? Because again, it's prepared for the single given level of activity. Now the question is, what's going to happen if the actual activity that we reach is not exactly the same that was on the budget? Well, in that case, the answer is very simple. We cannot do comparison. Why? Because we're in different realities. Then we have to do some adjustments. So let's see. We have select data from the budget and the actual sales. Data for this company for the first and second quarter. We budgeted our sales to be $180,000. Our sales are $179,000. So the sales are going down as a dollar amount. Second quarter, we budget that much, we achieve that much, so we're going down. So what we can get on this report, the only thing is we can compare the sales one period to another period and see that our sales in general for two quarters in a row going down. Now on the 2 quarters, when you have 2 quarters, it's hard to talk about trends. For trends, you need at least 3 periods in order to talk the trend. but at least you can talk about here of some kind of what will be that? If it's on trend, there's a differences between one quarter and another quarter, and the difference is that our sales going down. Now, the sales budget for the first quarter, if we take a look closely, we can see that actual is below the budget. So we have unfavorable difference of $1,000. Why is unfavorable? Because we're talking about sales. Every time when we're comparing sales and the sales are below to what we're expecting, that's unfavorable for us. So the variance against is favorable because it's the less. Every time we're going to have unfavorable difference when we have difference between the actual and budget. When the actual sales are less than the budget, that's unfavorable. Now, if we have to talk about costs and expenses, it's the opposite way. So we're going to have unfavorable variance or difference only and only for the cost when our costs are higher than what we expected or more than what we expected. So as you can see, sales, if the sales are higher than what we're expecting, that will be favorable, not unfavorable, but on the cost, when they're higher than what we're expecting, that's unfavorable. Say the favorable is the opposite. Again, for the sales, if we're getting more than what we're expecting, that's favorable. For the cost, we have to get less than what we're expecting. That then will be favorable. We're going to talk a little bit more with examples, so you're going to see exactly what's happening. So here for the sales, again, for the sales, what we can see is that the sales are going down. That means that's unfavorable for us. Now, if we have to prepare the budget for the second quarter, that report shows that the second quarter sales were 10,500 below what we expected. So we were expecting 210,000. Our actual sales are 199. So now on the cumulative, as you remember from the first chart, what was that cumulative? That's the second quarter we behind. Now we're falling down with 10,500. But cumulative for the first and second quarter, now we're falling 11,500. Unfavorable. Now we can express this as a percentage, obviously, and that would be 5% of the second quarter sales. We are going down. What's the limitation? Now those static budget report is appropriate only and only to evaluate effectiveness. So the actual level and the actual closely approximate in the master budget, and behavior of the cost is fixed in response to changes. So basically, the starting budget useful, but not so much. It can only give you the differences. Mostly, we're using it to compare what was the budgeted sales versus the current sales and how the sales are. What's the difference in sales? That's all. We cannot analyze anything else. It will be difficult to use it for the evaluation performance purposes.
Professor?
Yes.
If the sales is exactly equivalent to the budgeted sales,
Then
do we describe it as favorable?
Then we can compare it. If you hit the sales, if the actual sales are exactly the sales that you have on the budget, then you have no problem. Then you can use it.
Now I'm asking, will it be called favorable?
Oh, yeah. No, if the actual sales are exactly the same like a budget sales, then there's no variance.
No, you know, the other one you said is favorable and unfavorable.
Right.
I want to know now, can we now say because it's equal, we call it favorable, right?
No, if let's say here, for example, what was that example here? Let's say the first quarter, the sales are 180, right?
Yeah.
And the actual is 180 as well.
Mhm.
What's the difference?
0.
0.
Mhm.
Is that favorable or unfavorable?
That's what I think it should be favorable.
I think it's neither. It's just 0. You're exactly where you want it to be, right?
Okay.
You're exactly where you want it to be. So that's neither favorable, neither unfavorable. You're right on the spot. Make sense?
Oh, yes,
So
sir.
so listen, it's very interesting point here. Watch this. You have a standard. Make sense? You have
Mhm.
a standard. Suddenly start falling behind the standards. Your standard is to reach $210,000 sales. You're not reaching it. You're 199. So you're falling behind $10,000, right?
Mhm.
Now, you don't want to punish your people because in the contrary, you want to encourage them. Make sense?
Yeah.
So you have to be very careful here because if you punish them, you may actually go back, and that's the third quarter, the results can be even worse. You don't want that. So let's say the third quarter, the difference instead of $10,000 start improving, getting only $5,000. Now the question is, should you reward your people now?
Mhm.
Do you understand my question?
Yes.
So again, in the second quarter, they fall below the standards. So that means something bad's going on. On the third quarter, they catch up, but they didn't catch up everything. They catch up only 50%. So now you're behind only $5,000, not $10,000. Would you reward your people?
Yes.
What for?
They are improving, and then to encourage them to continue.
So the question is, what is improvement then?
They are perform better than the first quarter,
They're better than the second quarter, yes.
than the
That's no
second
question.
quarter. Yes.
So now we're going to the very interesting point. And following me here, I want you to understand the whole, how can I say, the complexity of this. You're expecting 210, but you're not getting it. So you have standards. People don't meeting the standards. They falling below the standards. The next quarter, you still have the standards. They still not reaching the standards, but they improving from the bad situation they were before. But they still not reaching the standards. Do they deserve reward? Do you understand this?
Mhm.
Yes, they're getting better, but they're still not on the standard. Because technically reward, or you have to show appreciation for the people who are above the standards. Correct?
Yes.
Yeah, but those people, they're below the standards. Yes, they're improving, but they're still below the standards. Do they deserve the encouragement and reward?
No, maybe no. No.
I believe, Professor, that they should meet the standards, because if they won't be able to, it defeats the purpose of the standard.
Right. So do you understand this logic?
Yeah.
So again, they're improving, no questions about it. But they're still below the standards.
Mm.
Do they deserve reward? That's the question that I want you to ask yourself. Because you're going to see so many examples in life that you set yourself a standard and you start falling below your standards. Then you start improving, but you're still below your standards. So is that improvement that you made deserve a reward? Think about it. That's for you to think. That's a challenging thing for you to think. Because you're going to face a lot of things in your personal life like this. You're going to set the standards. People's going to start going below the standards. You have to encourage them to improve. But they're improving, but they're still below the standards. Did they actually improve? Yes, they're not making the mistakes that you used to make. But is that improvement? Or that's just getting back to the standards? So what's the limitation of the static budget? What do you think?
Data at one level of activity.
Yes, it's done only for one level of activity. It doesn't tell me anything else. Not the timeliness, not the specifically, it's not data for the many. It's only one level of activity, and that's a limitation. So what do we have to do? Let's first do this. We have prepared the following partial static budget. Sales, actual, budget, actual, difference. Cost, budget, actual, difference. Expenses, budget, actual, fixed. Which of the following is the correct regarding the variances? So here, which one is favorable, which one is unfavorable? Is this favorable?
Yes.
Our budget for this one
This is
actually, that's a favorable. Okay, let's mark it. This one is favorable, no questions about it. Cost, we budget for that cost. The actual cost is that much. Is that favorable?
Yes.
No.
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 Why?
It's
Because
unfavorable.
I'm
Okay.
expecting, make sense? I'm expecting to spend $409,000. I'm spending $455,000. Is that favorable?
No, no.
No, that's unfavorable. And the last one, I'm expecting to spend 310. In reality, I'm spending 295. Is that favorable for me?
Yes.
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 So what's the answer then?
Sales, C.
C is the answer.
C is the answer. So why C is those are favorable and the fixed manufacturer overhead is unfavorable. Make sense?
Mhm.
Yes.
Okay, let's move to the next one. C is our answer. So flexible budget. What is the flexible budget? Flexible budget is something that we have to prepare based on the static budget, but it's gonna give us idea for the different level of activities. So that flexibility will be in the level of activity. So we're gonna prepare the same budget, like a static budget. We're gonna using the same assumptions, but we're gonna prepare it for the different level of activity. And that can be prepared for any type of budget. And that will be our assistance for the controlling the cost and making comparison between the cost. Again, we're gonna start with the main budget, which is the actual. On the actual, we're gonna check this, what's happening here. So let me make it like a here. So what's happened? Cost. I see that if I budget 10,000 production, that will be my cost. But if my actual is 12,000, make sense? My actual results is 12,000. And I'm seeing when my actual is 12,000, this is my spending. Now, let me flip this one in the Excel spreadsheet. Just a second. Let me see if I can flip it easy. Doesn't give me that option, but I should be able to somehow. No, it's not Excel spreadsheet, it's just a picture. Okay, let's try something else. No. Anyway, let's move to Excel. You know me that I like Excel better than PowerPoint. So this is my picture here. Can you see it?
Yes.
So what I have my budget and I have my actual. Now the budget is for 10,000. The actual is actually 12,000. Can I compare numbers for something that has production 12,000 and something that has production, because that's my production.
Mhm.
Now the question is, am I on the same reality here? Are we on the same reality? Budget versus actual on the production side?
No.
No. Where we are here, we have a difference in production, which is
2,000.
2,000. 2,000, that will be favorable, right? Because we're producing 2,000 more. Then I'm gonna have my cost, excuse me, which is the first one will be indirect material. Then we're gonna have indirect labor. Then we're gonna have utilities. Then I'm gonna have depreciation. Then I'm gonna have my property taxes. And the last one is supervision. Right, those are my costs. So my budget is 250,000 for the indirect material, 260,000 for the indirect labor, 190,000 for the utilities, 280,000 for the depreciation, for the property taxes 70,000. And the supervision I need 50,000. Right? Those are my costs that I budgeted. My actual results are 295,000 on the indirect material, 312,000 on the indirect labor, 225 on the utilities, 280,000 on the depreciation, 70,000 on the property taxes, and 50,000 on the supervision. So the question is, where are my differences here? Let's make it a little bit bigger so you can see the numbers. Where are my variances here? Those are my variances here. Actual versus budget. So my cost every way goes up, right?
Mm.
Is that favorable for me?
No.
No, that's unfavorable. Since it's cost, that's unfavorable. No questions about it. That's unfavorable as well. My total cost should be that much. My actual costs are that much. Obviously, will be higher. So I have here also I have difference, which is unfavorable, unfortunately, $132,000. Do I have to worry about this? Would you worry about $132,000 difference between actual and budget?
Yes.
Yes.
So the question is, again, the question is, are we in the same reality? This is my only question. Are we in the same reality, people? Because we're comparing budget. Here, let me highlight it in different color versus the actual. What is our budget? Our budget is for 10,000. Our actual is for 12,000. Well, obviously, if we produce more units, obviously we have to spend more on the indirect material. Why? Because we naturally producing more. We're supposed to spend more. Make sense?
Yes.
So imagine this. You're budgeting to go to the movie. You know, the ticket price is 20 bucks. Right? And you're budgeted to go with 5 people. For 5 people, you're supposed to spend 100 bucks. Right? Now, you're not going with 5 people to the movie. You're going with 7 people to the movie. And you spend 150 bucks. Well, obviously, if you go with more people, you have to spend more. Make sense? So now
Yeah.
the question is, how I can figure out, is this actually favorable or unfavorable? There's only one way. I have to do something here. I have to insert something and I have to prepare budget for 12,000 units. Make sense?
Yes.
And that's how, and only how, I can find out, is the budget actually comparable with the actual, and where are my actual differences? So let's do that. I'm gonna leave this one here, and I'm gonna copy this right here, and we're gonna start working on the new ideas here. First, what do I need first? Obviously I need to plug here. I'm gonna plug here only 2 columns, and I'll tell you why I'm plugging 2 columns. First column is, actually I can plug one more. No, I can leave it this way. So the question is, how the costs behave. We know how the costs behave, because behave as a variable and fixed cost, correct?
Yes.
So indirect material, is that will be variable cost or fixed cost?
Very.
That will be variable cost, right? Because more we're producing, more we have to pay. Indirect labor, is this the variable cost or fixed cost?
Very. Yes.
Variable cost. Utilities, is that going to be the variable cost or fixed cost?
Very. Yes.
Variable cost. How about depreciation?
Fixed cost.
Fixed cost. How about property taxes?
Fixed cost.
Fixed cost. How about the supervision?
Fixed cost.
Fixed cost. How the fixed costs behave?
It remains static.
Doesn't
They-
change.
They don't change. So let's get the new budget. So budget. So first, in order to get this budget, we need to do some calculations here. Shall we do it here, or let's put here one new column? Not all the way. I wanted to plug it only here. And then I'm gonna do some adjustments. So we figure out, oops. We figure out that this is a variable cost, correct? So what do we need? We need the cost per unit.
Mm-hmm.
Make sense?
Mm-hmm.
How much is our variable cost per unit here? Can I calculate it? What do you think? Can I calculate my variable cost per unit here?
Yes.
How? I have my
By
total
dividing.
cost divided by the production, right?
Yes.
So my variable cost per unit will be this one divided by that one. And I can log this cell because that will be there. So it's 25 bucks, right? You can see it. How about my indirect labor? Same idea, $26. How about my utilities?
19.
$19. Do I have to do the same thing for the depreciation, property taxes, supervision?
No.
No, those are fixed costs. I don't need to do that. So now, can I prepare a new budget for the 12,000 units if my production is 12,000? I can, right? So how much will be expected cost if we're producing 12,000? This one time 12,000. 300,000. Make sense? How about the next one? Next one should be 312. How about the next one? Next one should be 228. Now we're going to the fixed cost. How much should be the fixed cost?
280.
280. How about the property taxes? Same. How about the supervision? Same. Right? So let's highlight this in different color. Let's give it some more creativity here. Let's move it to greenish kind of color. So this is our budget now for the 12,000 level of activity. Now, can I compare now my budget with the actual? Now I can compare, right? Because now it's apple to apple. Now I can see where I am. So what will be my variances now? My actual is this much. My budget is that much. So my cost is below. Is that favorable or unfavorable?
Favorable.
That's favorable. So do I have difference? First, do we have difference between the actual and the budget? Now I don't have difference, right? Since I don't have this difference, now I can get the variances. If I drag it down, what's going to happen? There's no differences on the indirect labor, but there's another difference on the utilities. Negative 3,000. Is that favorable or unfavorable for me? That's favorable. Why? Because the cost going down. So, where's my overall variance? Minus this one. Negative 8,000. Is that what that means? Negative on the cost, negative 8,000. Favorable or unfavorable? That's a favorable, right? So look what happened. From 132,000 unfavorable, because we are different in reality, suddenly we are $8,000 favorable. Which one is correct? The first one or the second one?
The second one.
The second one. Why? Because we're comparing now apple to apple. Make sense?
Yes.
That's how you're moving from the static budget into the flexible budget by adjusting it to the level of the actual activity, using the assumptions that you use to prepare the static budget. And once you become to the same reality, then you can compare the budget numbers with the actual numbers and see, are you favorable or unfavorable? Are you saving money or you're losing money? Make sense? All right. Let's stop sharing this. Let's move to the slides. And now we can fly through the slides. All right. Let's bring it back to where it is. This one. And let's leave it here. So now, flexible budget. What we're going to do for the flexible budget? First, we're going to use the static budget to identify what cost is what which is variable, which is fixed. Once we do that, we're going to calculate how much is the variable cost per unit. Once we get the variable cost per unit, we can prepare the new report, which we prepared, and we're going to figure out that our actual variance is $8,000 favorable. So technically, we're not only not overspending money, but we are actually saving money. How much we're saving? We're saving $8,000. So how are we going to develop the flexible budget? First, we have to identify what's the relevant range of activity. Then we have to identify which cost is fixed, which cost is variable. The variable cost, we already know how they behave. So the variable cost per unit doesn't change. So we have to come up with the variable cost per unit. On the fixed cost, once we identify it's a fixed cost, we have to understand that the fixed cost in total doesn't change. Once we have those assumptions in our head, then we can prepare the flexible budget for the level of activity, which is exactly the same as actual. And then we can compare apple to apple. So the flexible budget for this company. Manufacturing overhead cost comparison for this company on 20 master budget, they show the expected operating activity 120,000 direct labor hours. And those are the overhead cost. Now what happened with this company? They identify activity index for the relevant range and that activity reading direct labor hours. The relevant range is for 8,000 to 12,000 direct labor hours. So once we stay from the 8,000 to 12,000, that's our relevant. Then we have to identify which cost is variable, which cost is fixed. Obviously, for the variable cost is the indirect material, indirect labor, utilities. We calculating from this information, we calculating the indirect material per unit, indirect labor per unit, utilities per unit, having in mind that expected capacity 120,000. That's how we prepare the master budget. We come up with the variable cost. Fixed cost is fixed cost. Then what we can do, we can prepare our new budget with increase of activity with $1,000. Make sense?
Yes.
Do you understand how we prepare this? Do you have to show you step by step?
Yes, please.
Okay, let's go. Excel. Let's move to Excel. Just give me a second to put the information in Excel, and then we're going to start working. And our level of activity was 120,000. Expected capacity 120. Okay. And move now to the Excel. And this is our Excel spreadsheet. Can you guys see it?
Yes.
So what do we have? I have my variable cost. I have my fixed cost. And what do I have to do? And I have my direct labor hours. So what do I want to do? I want to prepare different budgets for the 8,000, 9,000, 10,000, 11,000, 12,000, different number of the hours with the 1,000 incremental. Incremental, that means increase. How can I do that? Very simple. First, I have my costs, right? Those are my costs. Then this is my variable cost. Then I have my fixed costs. I'm just gonna put it one after another. I'm not gonna make it that fancy that is on the slides, so slides can be better than us. We have this. Those are our costs, right? Let's insert some rows here. Those are our costs. Where we want to be our direct labor hours used. Activity, direct labor, the direct labor hours. We want they to be, let's format those ones. We want those direct labor hours to change. How much they want to change? We want to change with $1,000. So what will be our starting point? Let's start, they're starting with 8,000. And then we're gonna keep going, right? How much will be the next one? 8,000 plus 1,000. And we're gonna keep going. And we're gonna prepare as many budget as we want. Can I do that? Who's gonna stop me, right? Excel spreadsheet, we can do whatever we want. We on the Excel spreadsheet, we can increase as much as we want. So now the question is, what do we need here for the cost? We need first, which one behave, how they behave. Those are our variable costs. Those are our fixed costs. Correct?
Mm.
How much is the fixed cost? Depreciation, 180,000. Supervision, 120,000. That's 12, 120, 1, 2, 3. And the property tax is 60,000. How are they gonna change? Are they gonna change?
No.
No. So what I can do, I can easily say this one is equal to that one, and then I can just drag it down all the way to the end. And that's never gonna change.
Mhm.
How about the other two? Same,
Mhm.
they're not gonna change. And since not changing, let's make it the same formatting. And we're done with the fixed cost. So what do we have to do now? To figure out the variable cost, right? How can we figure out the variable cost? What do I need?
Divide this.
I need the variable cost per unit, right?
Yeah.
How much is my variable cost per unit if my production is 120,000 direct labor hours? If this is the cost for 120,000 direct labor hours, how much is the cost per unit here?
It will be 120,000 divided by
180,000 divided by 120, right? 1.5. And I want this as a dollar amount. But I want it with the decimals. How about the indirect labor? That will be equal to 240,000 divided by 120. That will be $2, right?
Mm.
And what's the last one left? Utilities. Utilities 60,000 divided by $120,000 reality. So that will be 0.5, 50 cents. So once I know my variable cost per unit, can I prepare my budget for the 8,000, 9,000, 10,000, and so forth?
Yes.
Yes. How will be that? This number times that number. And now I'm gonna log 1.5 because I don't want 1.5 to change, but I want everything else to change. Make sense?
Hmm.
So now I have my first costs, which, as you can see, every time when I increase the level of activity with $1,000, I have increased with $1,500. Does that make sense? Yes. So the next one, what I'm gonna do, $2 times this number, and I'm gonna log C16, and then I'm gonna drag the formula all the way to the down, and I have my next cost. Just like that. And the last thing left for the utilities. That will be equal to this one times that one. I'm gonna log the first cell, and I'm done. And from here, there's so many options now. I can calculate total variable cost, total fixed cost, or the total cost directly. Let's go directly with the total cost.
Okay, so you need to make corrections for your depreciation. You
Which
need to
one?
add an extra zero for depreciation is 180,000.
180 right away. 180. 1, 2, 3. Boom. Done. Thank you. 180, right? So at this point, I can easily calculate the total cost, right?
Mhm.
Let's put it this way and format all the cells. And this one's gonna be this way. And now I can drag this one all the way to the end. And I have all my costs. So let's see how much is my costs. Make sense?
Mhm.
Yes.
And now we have the budget. The only thing left is to format those cells here. And once I formatting, I can easily put it in the big table here with the thickness on the side. Those will be my thickness as well. Those are my assumptions I wanted to tick. And there you go. That's a perfect budget for you to use. You can easily, if you want to make it fancy, you can use different fonts here. You can variable cost, you can get the variable cost that way. And the fixed cost is a little bit not that fancy. That's your fixed cost. And the total cost is in some different color. Let's put it in the light blue, and we're done. Just like that. So now let's stop with this one. Let's move to the PowerPoints again. They naturally should come up with the same ideas. What's the difference here? Depreciation 15,000. What they did with the depreciation? Oh, the depreciation is they change the numbers of the depreciation. That's why. So we come up with the cost per month of 15,000, 5,000, and 10,000, and that's how they adjust those numbers. So once we have this, we can see on which level how much cost we have. So what's happened here? What we can see, the fixed cost stays the same. The variable cost is the one that's moving from one level to another level. Keep going, keep going, keep going. Let's do this. How can we develop the flexible budget management? To develop the flexible budget management, should take the following step. Which one is the steps?
B.
They all.
Most likely all of them, right?
Mm.
Let's try this one. What are you doing? Doing together or you doing by yourself?
You can try the answer.
Okay, try it.
See, easy answer.
Which one is the answer?
See.
So what we have here? We have this company which is budgeting the fixed manufacturing overhead. The budgeted fixed manufacturing overhead is 100,000. And per unit variable cost is 350, 350 for direct material, 350, 895 for direct labor, and 410 for the variable overhead. So the fixed manufacturing overhead, that is 100,000, right? So those two will disappear. Which is the level of activity that we're chasing? We're chasing 10,000 units, and we're chasing 14,000 units. Make sense?
Mhm.
So what is our answer?
Letter C.
Letter C. All right. Good job. Let's keep going. Letter C is the correct one. So the flexible budget has two sections. Production data for the selected level of activity, such as direct labor, and cost data for variable and fixed cost. So on this flexible budget, what we can see? Direct labor usage, again, the budget is equal to the actual. And when those two are in the same reality, then we can compare the actual versus the budget. And as you can see here, every time when the cost, since we're in the cost, here, if the cost is higher than the budget, that's unfavorable. Every time when the cost is lower than the budget, that's a favorable. And we can compare the variable cost with the fixed cost and see which one is what and where's the variances. Responsibility accounting concepts. So now we're gonna evolve accumulating the reporting cost on the basis of the management who has the authority to make the day-to-day decisions. We're not just gonna go over the variances and start blaming everybody. We're just gonna check who is responsible on the day-to-day activities to make decisions about these costs, and then we're gonna ask for questions. Management performance obviously will be evaluated on the matters directly involved on the cost that the management can control. And we may extend from the low level of management to the upper level of management. Now, the responsibility accounting is useful for each level of management. As long as the following is available, which is the cost and the revenue can be directly associated with that level of management. Cost and revenue for controllable from the management, and the budget data can be developed for evaluation of the managers. Obviously, responsibility accounting promote the decentralization level of company, where we're giving the manager control over to some extent, to control on the activities that they're doing. The key differences between the responsibility accounting and the budget reporting is that responsibility accounting can distinguish what's controllable versus what's not controllable. Where the budget focuses on the fixed cost, on the variable cost. And also responsibility accounting we report only those one who manager has control. That will apply to both profit and non-for-profit enterprises. What's the controllable versus non-controllable cost? Controllable cost is the one that manager can actually influence by changing the level of activity. Non-controllable cost is the usually a cost which is indirectly happen and allocated to the responsibility center where the management has no control over that cost. So the manager cannot change anything about that cost. That will be, the example will be depreciation of the machine. The machine just depreciated. Is the manager can do anything about the depreciation of the machine? No. But can the manager control the direct labor, the direct material cost? Yes, he can. So the principles of the performance evaluation is the responsibility accounting need for those performance evaluation to be effective. Not only we do it, but only to give the effect. And those are fully affected only and only when contain only the data which is controllable by the responsibility center. Provides the accurate and reliable budget information and highlight only the significant differences between the actual and the budget. Management is going to review those budgets and the differences, and we're going to focus only on the one that we can control and the one that are material. Material means that are above certain percentage, and controllable is the one that we can actually control. So the responsibility centers, managers, should be directly involved when we're setting the budget goals, so they understand what we're doing. Then the performance evaluation should be based entirely on the things that the manager can control. All the top managers should support that evaluation process, and this evaluation process should allow the managers to respond to the evaluation. Obviously, we can go with the good and bad performance, but we always gonna stay objectives, and when something goes bad, we have to say it's bad. When something goes good, we can gonna say good. Which of the principles? Performance report should only provide data which is controllable by the responsibility centers. Second, provide accurate and reliable budget data. Highlight the differences, high differences, which are material. Has to be tailored to the intended evaluation. If you're evaluating the managers on how much cost he saved on the direct material, you're not chasing manufacturing overhead, and you're not bringing the variances on the manufacturing overhead. And it has to be prepared on the intervals of time which are reasonable. So obviously we have to prepare for each level of responsibility. Who's going to begin with the low level and moving up. Permit management always to work on the exceptional level. That's going to permit comparable evaluation and going to give them some incentive for the control purposes. And the factory manager can rank the department management effectiveness. Which are the responsibility center system, how the exactly system works. Obviously on the top is the top, and everything going down, 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 all the way to the very small level of activity. Head office, divisional offices, factory, which are responsible for these divisional offices, and in every single factory, we're going to have the level of the managers which are responsible for the single activities. How are we going to prepare the report? First, this person get the report. This person send the report for those people. Those people send the report to these people, and these people send the report to those people. So let's see here how exactly works. The president, El Presidento, checking the report, and he's seeing that production we have unfavorable difference on the cost side of 7.3, or it can be $1 million. Let's put it $1 million so we can create some drama here. $7.3 million. So he's saying, okay, give me the more detailed information about production. So he going with the production manager, the heads of the production, and say, give me more information about this production. What's happening with this $7,300? So he bringing the report and he say, okay, in our facility, which are in Toronto, Montreal, and Halifax, Toronto, Montreal, and Halifax, production looks this way. We're chasing now only the $7,300. From where they're coming from. And we're identifying that in Toronto, we have that much. Montreal budget is that much and that much. The difference is 7,300 in the production. 7,300 unfavorable, but the highest one comes from Montreal. $5,300 comes from Montreal. So what we're going to chase now, we're going to go directly to Montreal factory and we're going to see what's happening in the Montreal factory. What these people doing there? In the Montreal factory, the variance is 5,300 unfavorable. So we're checking with the managers there and we're chasing the fabrication, assembly, and enabling. On those three departments, what we can find out. Fabrication has unfavorable 1,300. Enabling has unfavorable of 2,000. And assembly has favorable 1,000. Overall is 5,300. 5,300 that we're chasing for the Montreal factory. So now we find out where does 5,300 comes from the fabrication and enabling. So let's chase the fabrication. In order to get the fabrication, we have to get the detailed report for the fabrication itself. And in the fabrication department, we have direct material, direct labor, and overhead. And those 1,300 counts because we have on the direct material 500 unfavorable, direct labor 1,000 unfavorable, and the overhead 200 favorable. So you can see how from the very detailed small report of the very small details, direct material, direct labor, overhead, we can climb to the divisions, departments, we can climb to the factories, we can climb to the overall report for the company. So if you want to find the production, then go to the factories. From the factory, move to the departments, and from departments, move to the actual cost. And this is the link between the report D and report C and all those examples that we see. So in the report D, that's a typical for the loss responsibility center. Report C is one level up for the factory level. Then we're going for the department level. Then we're going to the factory level, the controllable, and the total. The first report is the one that the president look and then start asking for all the other reports. A responsibility accounting for the cost centers. Well, the cost centers is the one whose managers is responsible for the cost. We're going to include in the report only the costs which are controllable by the manager. And there will be no distinction between the variable and fixed cost in that case. So what will be that? Department manager on the controllable cost, we're going to check on all the costs except depreciation, property taxes, and their own monthly salary of $6,000. So we're going to see indirect material variances. So now I can start chasing what's the variances, which one is there any variance that can drag my attention. And if I see something that drags my attention, I can ask for more detailed report on that particular one. Now the profit centers. The profit centers, the managers will be responsible for the revenue and cost. The manager will control all the variable costs and expenses, and they can control all the operating revenue. That's why it's called profit center. A responsibility accounting for the profit center is we're going to split the direct fixed cost and indirect fixed cost. Direct fixed cost is the one that who are related explicitly to that center, which are traceable to that center. Indirect is the one that company overall operating activities are related to the company overall operating activities. Reports, we're going to have to prepare a report only for the cost which is controllable and the revenue also which is controllable. Based on that, we can prepare cost volume profit analysis statement on controllable contribution margin and non-controllable fixed cost. Those are not reported at all. So the report is going to look like this. We're going to have the sales. We're going to have the cost of goods sold split by variable cost. And then we're going to have cost of goods sold as a fixed cost, selling administrative expense, fixed cost, and we're going to have controllable margin, which is only and only for this responsibility center. Try this one.
Division center.
Division center is not the one who is responsibility center. Okay. How about this one? Let's check this. And this one, the right answer should be the correct answer here. Let me fix this one. I'll fix it later. The correct answer should be D, which is the allocated head office and manager salary are included, which they shouldn't be. And the contribution margin is not reported. Only controllable margin is reported. There's no contribution margin. How are we going to evaluate the investment center? Investment center, we're going to evaluate it by return on investment, or how effectively the manager using the assets in there for which they have control and they can dispose. So how are we going to calculate the return on investment? We're going to get the controllable margin divided by average operating assets. And that's going to give us how much return we're getting from the assets that we can control. Operating assets are included on the current assets and the factory assets used for the operation of the center. Management has responsibility for only for the current assets as accounts receivable and certain level of cash in inventory. We're going to exclude the non-operating assets. So investment center report is going to look like this. And as you can see, average operating assets for this division are $2 million. What's the alternative measure of the return on investment? Now we have to calculate alternative on the inputs, the valuation of the operating assets. How are we gonna evaluate the operating assets? We can value it by cost or the book value or market value. How are we gonna calculate the margin, which is makes? We may use the controllable margin, or we can use the income of operation, or we can use the net income. Obviously, the best option will be the controllable margin. For that reason, comes to the question, how can we improve the return on investment? By increasing controllable margin or reducing average operating assets. Either of those is going to help us for our return on investment. We're going to do a little bit more talking on the return on investment in class. And I'm going to show you some other stuff on the return on investment. But let's do this first. Here we have, this is the data that we have for this division. We have the sales, we have the variable costs, we have the contribution margin, we have the controllable fixed costs, when we have the controllable margin. We have the average operating assets. Question is how much the return on investment? Obviously 600 divided by 5 million, 12%. With the $5 million assets, we are able to generate 600,000 income, which is we can control. Now, how this division manager can improve? First, he can reduce the cost. If he reduces the cost, the controllable margin is going to increase, return on investment is going to increase. Second, he can reduce the assets. By reducing the assets, return on investment is going to increase. Let's see first. If increasing the sale by 25%, that's going to increase the margin. And that's going to improve the return on investment. If you decrease the cost, that's also going to improve the return on investment. And the last option that we have is to reduce the assets. If we're reducing the assets, that's going to improve the return on investment. What do you think about this formula?
D.
Okay, and that would be the correct one. Because the operating income divided by average operating, or if we eliminate here the sales, is the same controllable margin average operating asset return on investment. So base B and C are the same. Let's try this one. Do you understand the question? And do you have any idea how to approach this question?
I can only use logic to know the answer.
Okay, so let's go to the formula first. This is our formula, right? Make sense? Let's get those formulas first. And let's move to that Excel spreadsheet. Give me a second just to put them here on the right place. Expand the formulas and start working on this. All right. And the actual question is right here. You can see my screen, right? Can you guys see my screen?
Yes.
Okay, so what do we have? We have return on investment, right? Return on investment. What else we have? Well, what else we have here? We have the operating margin, which is right here. Correct? profit margin, which is our operating margin here in this case. Operating margin. Which one are we missing? We're
The
missing investments, right? This is what we're missing. Everything else we have it, correct?
Yes.
Can I get my investment operating margin? Can I get my, no, this one is the sales operating assets. Can I get my operating assets? Let me see. Or is there any other formula here? Because this one formula is return on investment. This was the formula that I want. Just a second. This is the formula that I wanted in the first place. But that one overrides the other one. Let me do some magic here. And let's get the formula again. And this is the formula that I want. Right? The first two formulas I'm going to explain in the class how exactly they all work. But the return on investment we can get at controllable margin divided by average operating assets. I have my operating margin, which I can control. The only thing that I'm missing is average operating assets. How much is the operating margin?
257.50.
250, 750 times something that I don't know, right? I don't know this, something that I don't know. It has to be equal to how much?
14%.
It has to be equal to 14%,
ROI.
right? Or 0.14. So the question is, can you calculate it? Can you get me how much is this?
1,791,071.
1,791,071.
71.
So basically, that's not the answer, correct?
Yes.
We have it here as answer, but that's not the answer,
That's not the answer.
right?
Yes, that's
So-
the answer.
So what we're chasing here, since we know the assets, what they turn. If this one now is how much should be? If this one is 16%, sorry, 0.16, how much is this? That's what we're calculating here. Correct?
Yes.
So how much is it? Can you calculate it now?
Divide.
286,571. Multiply
No. Div-
17910.
So what's the
071
so what's the answer?
16%. 286,571.
286,571. Everybody get that number? Make sense?
Yes.
Awesome. So what's left for us here is appendix. We did return on investment. Let's spend a little bit more time in the classroom on the return on investment. And that was the question that we did. Now we're moving to appendix A, but let's leave the appendix A for the in class. And in class, we're going to talk about the residual income. There are only 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 slides left on the end. We want calculation of residual income, which is interesting. I want we to do this in class. And that's where we're going to stop today.